You know, when a token's price drops, it's so easy to just get fixated on that chart, right? But with Plazm, that's really only half the picture. Today, we're going to look past the price and focus on the real engine driving this whole protocol, a yield engine that's not just surviving under pressure, but actually thriving. This whole explainer is about understanding that core strength. And hey, just a quick reminder, this is all for educational purposes, not financial advice. Always do your own research.
Okay, so this slide right here, it tells the entire story in one single image. On one hand, the Plazm token price took a 19% hit, but on the other, the DexFi Vault, the protocol's actual engine, grew by 4.2%. Now, in most of DeFi, that is simply impossible. Usually when the token price tanks, the yield value goes right down with it. The fact that these two things moved in completely opposite directions today, well, that's not a bug. That's the Plazm model working exactly as it was designed to under stress.
So you're probably asking, how is that even possible? To get it, we've got to pop the hood and look inside the yield engine itself, the DexFi Vault. So let's break down exactly where that 4.2% growth came from and see how it's able to generate value completely separate from the token's price. First up, that big number you see. We're talking over $16,000 in growth from the Vault's active positions. And this isn't from token inflation. No, this is the real underlying value of the protocol's bond positions going up as they earn fees from outside traders. Think of it like the market value of your factory just went up because it's producing more.
And this isn't just, on paper money. The protocol also harvested over $1,000 in actual realized profits. We're talking tangible ETH and USDC claimed from trading fees and put directly into the Vault's reserves. It's real cash, ready to be used.
And get this, the engine isn't just sitting there. It's actively expanding. The protocol deployed 18 brand new DexFi bonds today. That shows it's being actively managed. It's constantly out there looking for new places to put capital to work and capture more fees, which just compounds the Vault's growth. It's not playing defense, it's on offense. So when you put it all together in a table like this, you get a really powerful picture of the Vault's health. And it's a fantastic picture. Every single key metric is up. The ETH balance, the USD value, the unrealized gains, and the claimed profits. It's a total clean sweep of positive growth, all on a day when the token price was down. So what's the bottom line here? When you add up all the working capital, the unrealized gains, and all those claimed profits, the total value of Plazm's yield engine right now is over $791,000. This number, this represents the true value of the protocol's productive assets. Okay, so seeing all this probably raises a big question. Why doesn't every single protocol work this way? And the answer comes down to a really fundamental difference in how they're designed. Let's break down the two main models you see in DeFi. Real yield versus inflationary yield. Understanding this is absolutely crucial to getting the whole Plazm thesis. The truth is, most protocols out there use what we call inflationary yield. You stake their token, and poof, they just mint new tokens out of thin air to pay you. And hey, it feels great when the price is going up, but there's a huge catch. This yield has no external source of income. Its value is 100% dependent on the token's marketplace, and that can lead to a nasty death spiral. And this is that classic vicious cycle. The protocol mints new tokens to pay out yield. The stakers who want to take profits then sell those brand new tokens on the open market. This creates constant sell pressure, which pushes the token price down, which then devalues the yield for everyone else. It's a cycle that, unfortunately, often ends very badly. Okay, now let's flip the script and look at the Plazm model, real yield. Here, the yield comes from a source that is completely outside of the protocol's own token. In this case, it's trading fees paid by actual traders on decentralized exchanges. This income flows in whether the Plazm token price is up, down, or completely sideways. So how does this actually work? It's a really simple and honestly beautiful flow. First, traders on an exchange pay a tiny fee for their swaps. Second, the DexFi bonds, which are providing the liquidity for those trades, capture those fees. And then third, 70% of all those profits are sent directly to the Plazm Vault. It's a simple, sustainable loop that actually adds value. So let's circle all the way back to the data we started with. How does today's data prove that this model actually works in the real world? Well, the token price dropped 19%. But because the Vault's income is external, it didn't just survive, it grew by 4.2%. The engine kept running, totally unaffected by the token's volatility. Okay, so we've established the yield engine is strong, it's resilient. But why is that so critically important right now? Because this daily accumulation of yield isn't just some abstract number on a screen. It's actively building a strategic defense fund,
a war chest for a major event that's right around the corner.
And that event is the Day 78 unlock, which is now just 19 days away. On that day, we're talking about nearly 2.3 million Plazm tokens being released. At today's prices, that represents almost $4 million of potential sell pressure. This is the single largest unlock in the protocol's entire history, and being prepared is everything.
So this is where that yield engine turns into a defensive weapon. The protocol's first line of defense is its active buy pools, which are holding about $82,000. But right behind that, you have the strategic reserve, nearly $44,000 in real, tangible profits that have been harvested directly from the vault, ready to provide support.
And this is where it gets really, really powerful. That war chest is growing every single day. If the vault keeps generating gains at the same rate it did today, about $16,000 a day, it could add over $300,000 more in value by the time Day 78 gets here.
So let's just step back and look at that trajectory. The vault is sitting at over $791,000 today. If this trend of real yield accumulation keeps up, the protocol's war chest is projected to grow to over $1 million by Day 78. That provides a massive cushion and just incredible strategic flexibility to handle that unlock event.
All right, so let's bring this all home and wrap up by coming back to the core thesis. What's the single most important thing to take away from all the data we've looked at today? It's the crucial difference between temporary price and permanent value.
We started with this slide, and we're going to end with it too, because it says it all. The token price went down. At the same time, the underlying productive value of the protocol went up. They moved in opposite directions. This isn't just a theory, right? It's an observable fact from today's data. It is the clearest possible proof of a real yield model succeeding under pressure.
And that really leaves us with this final thought, which is at the heart of the entire Plazm strategy. Market sentiment, token prices, they're always going to go up and down. That's temporary. But the daily accumulation of real assets earned from actual economic activity adds permanent compounding strength to the protocol. And that is the story that truly matters.